Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of the ultimate guide to technical indicators for smarter trading. Moving averages, SMA and EMA. Moving averages are essential tools for smoothing out price data to identify trends over time. There are two primary types: Simple Moving Average, SMA, and Exponential Moving Average, EMA. Simple Moving Average, SMA. The SMA is calculated by adding up the closing prices of an asset over a set period and dividing the total by that number of periods. For example, a 10-day SMA averages the closing prices of the last 10 days. It's easy to use and gives a general sense of market direction. Exponential Moving Average, EMA. The EMA, on the other hand, assigns more weight to recent prices, making it more responsive to current price movements. This feature makes EMA especially useful in fast-moving markets. Both SMAs and EMAs are widely used to identify trends and potential reversal points. When prices are above the moving average, it often signals an uptrend. If prices fall below it, it may indicate a downtrend. A common strategy involves using a short-term EMA and a longer-term EMA. When the shorter one crosses above the longer one, traders often see it as a buy signal. Relative Strength Index, RSI. The Relative Strength Index, RSI, helps traders measure the momentum of price changes. It's displayed as a value between 0 and 100 and is often used to identify overbought or oversold conditions. How RSI works: it compares the magnitude of recent gains to recent losses over a specific time period, typically 14 days. If the RSI is above 70, the asset is considered overbought, signaling a possible price correction. If it's below 30, it indicates oversold conditions, suggesting a potential bounce. Traders love RSI because it's simple and effective. It doesn't just highlight possible turning points but also shows when a trend has strong momentum. For example, a high RSI during an uptrend can confirm the strength of the trend, while a low RSI in a downtrend does the same. MACD, Moving Average Convergence Divergence. The MACD is a versatile indicator that combines momentum and trend following to provide actionable insights. It consists of three main components: MACD line, the difference between two EMAs, commonly the 12-day EMA and 26-day EMA. Signal line, a 9-day EMA of the MACD line. Histogram, the visual representation of the difference between the MACD line and the signal line. When the MACD line crosses above the signal line, it often signals a buy opportunity. Conversely, a cross below indicates a sell signal. The histogram helps traders visualize the strength of these signals. Larger bars suggest stronger momentum. Traders use MACD for both trend confirmations and spotting reversals. It's especially helpful during periods of sideways market movement, giving clarity when the market lacks clear direction. Bollinger Bands. Bollinger Bands are a favorite tool for analyzing market volatility. They consist of three bands: a middle band, usually a 20-day simple moving average; an upper band, which is 2 standard deviations above the middle band; a lower band, which is 2 standard deviations below the middle band. Here's how they're used. When the price nears the upper band, it signals that the market may be overbought. If the price touches the lower band, it could mean the market is oversold. Traders also watch for a squeeze when the bands narrow, indicating low volatility. A squeeze often precedes a breakout, though it doesn't predict the direction. Bollinger Bands help traders set entry and exit points and manage risk in volatile markets. They're like measuring the heartbeat of the market, calm or racing, they'll let you know. Stochastic Oscillator. The stochastic oscillator is another momentum indicator that traders use to identify trend reversals and overbought or oversold conditions. It compares an asset's closing price to its price range over a specific period, plotted on a scale from 0 to 100. Overbought and oversold levels. Readings above 80 suggest overbought conditions, while readings below 20 point to oversold conditions. What makes the stochastic oscillator stand out is its ability to signal a potential reversal before it happens. For instance, if the indicator moves out of the overbought zone and crosses below the 80 level, it might hint at a downward trend. Similarly, crossing above 20 from the oversold zone can signal an upward trend. Traders often use the stochastic oscillator alongside other indicators for confirmation, ensuring they don't act on false signals. It's all about timing the market's twists and turns, much like spotting the first signs of a change in weather. These popular technical indicators are the backbone of many trading strategies, helping traders navigate the market with greater accuracy and confidence. How to combine technical indicators effectively. Using multiple technical indicators can improve your trading decisions, but only if they're combined wisely. The key is to use indicators that complement each other while providing unique insights. Let's explore how to create harmony between different indicators and avoid common mistakes. Avoiding redundancy in indicators. Many traders fall into the trap of using several indicators that tell the same story. Why is this a problem? Because it adds clutter without adding value. For example, combining a simple moving average, SMA, with an exponential moving average, EMA, can be redundant since both measure trends, just with slightly different sensitivities. Instead, focus on variety. Avoid stacking indicators from the same category, like using the RSI, Stochastic Oscillator, and MACD together. While each has its perks, they all provide momentum insights, which can lead to overconfidence in your analysis. Stick to indicators that offer different types of information, one for trend direction and another for momentum, for example. This approach ensures you're not making decisions based on duplicated signals. Combining trend and momentum indicators. A great strategy is to pair trend indicators with momentum indicators. This combo allows you to identify the market's direction and gauge its strength. For instance, use a moving average, MA, to determine the trend's overall direction. If the price is above the MA, it's an uptrend. If it's below, you could be in a downtrend. Add a momentum indicator like the Relative Strength Index, RSI, to assess whether the trend has fuel or is overextended. A high RSI in an uptrend might signal a pullback, while a low RSI in a downtrend suggests the market could bounce. Another common combination is the MACD with the Stochastic Oscillator. The MACD helps spot trend changes, while the Stochastic Oscillator pinpoints overbought or oversold conditions. Together, they confirm entries and exits with better accuracy. Think of it as checking both your compass and speedometer. It helps you plan your next move with confidence. Using volume to validate signals. Volume indicators add an extra layer of confirmation to your trades. Why? Because price movements with high trading volume tend to carry more weight than those on low volume. It's like hearing a cheer from a packed stadium rather than a nearly empty one. The louder it is, the more you know it matters. For example, pair a volume-weighted average price, VWAP, with a trend indicator like a moving average. When the price moves above the VWAP with high volume, it's a strong bullish sign. If it dips below on high volume, it could signal selling pressure. Use the on-balance volume, OBV, indicator alongside the RSI. If OBV rises while RSI signals overbought conditions, the price may still have room to grow due to increased buyer activity. In short, volume is the market's heartbeat. It tells you whether price signals from other indicators are worth trusting or just noise. Customizing indicator settings. Default settings aren't always the best choice. Tailoring your indicators to match your trading style and the market you're focusing on can make a world of difference. For instance, short-term traders, if you're day trading, tweak moving averages to use shorter periods, e.g., a 9-day EMA instead of a 50-day SMA. This makes indicators more sensitive to price changes. Long-term investors. Longer settings, e.g., a 200-day SMA, can reduce noise and clarify bigger trends. Volatile markets. Consider narrowing Bollinger Band settings to tighten their sensitivity, making it easier to spot breakout potentials. When customizing, always test your settings. Backtest them in past market conditions to ensure they align with your goals. Think of it like adjusting the seat and mirrors in a car. You need everything set for your comfort and safety before hitting the road. By combining technical indicators wisely, avoiding redundancy, and validating signals with volume, you can create a more comprehensive and reliable trading system. Tailor these tools to fit your trading style, and you'll have a setup built for your specific goals. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.